Sweet Bakery first started in December 2018. These are the following transactions in December 2018. 1st of December 2018, Sweet Bakery invests cash in bank for 150 million. 2 machines. Each machine cost is 6 million with 8 years of useful life. And we have to make journal entries for each transaction. The first journal entry is cash in bank and machine to equity. These are the nominal. Next, Sweet Bakery top up the petty cash for 5 million from cash in bank. The journal entry is petty cash to cash in bank for 5 million. The 5th of December 2018, purchase office supplies for 500,000 with petty cash. The journal entry is supplies expense to petty cash for 500,000. The 8th of December 2018, purchase office equipment for 12 million with 4 years useful life. 2 units of computer, each cost is 4 million. 2 units of printers, each cost is 2 million. The journal entry is office equipment to cash in bank for 12 million. Next, the 9th of December 2018, purchase a fridge for 6 million with the useful life of 8 years. Payment from cash in bank. The journal entry is fridge to cash in bank for 6 million. Next, 31 of December 2018, pay the rent fee of building for December 2018 with cash in bank. Rent fee is paid at the end of that month. The journal entry is rent expense to cash in bank for 7 million. Next, pay utilities expense in December 2018 for 1,500,000. The journal entry is utilities expense to cash in bank for 1,500,000. Note: there is still no worker in December 2018, so there will be no salaries expense. There is no sales in December 2018. At the end of December 2018, the following data is needed for adjustment. First, depreciation of machine. The journal entry is depreciation expense machine to accumulated depreciation expense machine for 125,000 from this calculation. Next, depreciation of office equipment. The journal entry is depreciation expense office equipment to accumulated depreciation expense office equipment for 250,000 from this calculation. Next, depreciation of fridge. The journal entry is depreciation expense fridge to accumulated depreciation expense fridge for 62,500. After all the journal entries, we have to make profit or loss for Sweet Bakery for the year ended December 2018. The balance for all accounts in the report are from the journal entries. There is no sale in 2018, so it will be 0 for the gross profit. Next are the expenses. There are supplies expense, rent expense, utilities expense, depreciation expense machine, depreciation expense office equipment, depreciation expense fridge. You will get the total expense 9,437,500. There is no other income and expense also. So lastly, the net income is 9,437,500. We also have to make statement of financial position for Sweet Bakery as of 31st December 2018. Cash in bank plus petty cash. This is the total current asset. Next, property, plant, and equipment. There are machine, office equipment, fridge, less accumulated depreciation expense, machine, accumulated depreciation expense, office equipment, accumulated depreciation expense, fridge. This is the total property, plant, and equipment. And you will get the total asset. Next is liabilities. But there is no liabilities for December 2018. And the last is equity. Equity less current earning of the years. You will find this balance in profit or loss. This is the total equity. Will balance with the total asset.
So next is inventory management. Currently, CP Sweet Bakery is under traditional method which need to save part of the stock to prevent shortage in future. Because of applying traditional method, CP Sweet Bakery has to rent a warehouse for keeping stocks. Renting warehouse is recorded as fixed overhead cost in the report. It is included in the rent expense cost 1 million from total cost of 12 million per month. But CP Sweet Bakery is trying to adopt and apply just-in-time inventory method in future, which means that by applying just-in-time inventory method, there's no need for CP Sweet Bakery to keep stocks, so it could help to save cost by 1 million for each month, and it will increase the profit. As we could see, the rent expense is 12 million, the cost saving is 1 million, and the total rent expense will be 11 million. And next is quality costing. So, in the quality costings, there are prevention costs, appraisal activities, internal failure, external failure. And all of these costs will be recorded as other expenses and selling and administrative expense. The increase of quality costs from January to March is because of the increase of sales. The estimation is based on the increase of sales.
The following transactions are the information for the static budget for the first quarter of 2019 of Sweet Bakery. First, unit sales by the quarter are projected as follows. January 6,000 loaf, February 7,000, March is 7,500, April is 7,500. And we have to make the sales budget. First, put the sales unit for each month and also the unit selling price. The total sales unit multiply the selling price. You will get the total sales budget for each month and also per quarter. Next, we have to make the production budget. Input the sales unit for each month and also the desired inventory, which is 20% of the next month estimate sales. As known is the list of information. Total sales unit plus desired ending inventory, we will get the total net. Total net less the beginning inventory, we will get the total production budget. For the January, there was no production in the last year, so there is no beginning inventory in the January 2019. Next is the direct material purchase budget for flour. Input the production unit which was calculated in the production budget and then multiply the material used per unit, so we will get the production need. Total production need plus the desired ending inventory, we will get the total need. The ending inventory is 20% for the next month estimate sales as known in the list of information. Production need plus the desired ending raw material inventory, we will get the total needs for production. Total needs for production less the beginning inventory, and we will get the purchase of direct material. The beginning inventory is 20% from the month estimate sales. For the January, there was no purchase of direct material in the December 2018, so there no beginning direct material in January 2019. Total purchase multiply the cost per unit, we will get the direct material purchase budget. Next is the direct material purchase budget for sugar. Input the production unit which was calculated in the production budget, and then multiply the material used per unit, so we will get the production need. Total production need plus the desired ending inventory, we will get total need. The ending inventory is 20% from the next month estimate sales as known in the list of information. Production need plus desired ending raw material inventory, we will get the total need for production. Total need for production less the beginning inventory, and we will get the purchase of the material. The beginning inventory is 20% from that month estimate sales. For January, there was no purchase of direct material in December 2018, so there is no beginning direct material in January 2019. Total purchase multiply the cost per unit, we will get the direct material purchase budget. Next is the direct material purchase budget for egg. Input the production unit which was calculated in the production budget, and then multiply the material used per unit, so we will get the production need. Total production need plus the desired ending inventory, we will get the total need. The ending inventory is 20% from the next month estimate sales as known in the list of information. Production needs plus desired ending raw material inventory, we will get the total needs for production. Total need for production less the beginning inventory, and we will get the purchase of direct material. The beginning inventory is 20% from the month estimate sales. For January, there was no purchase of direct material in December 2018, so there's no beginning direct material in January 2019. Total purchase multiply the cost per unit, we will get the direct material purchase budget. Plus the direct material purchase budget from above calculation, and we will get the total direct purchase budget. Next is the direct labor budget. Input the production unit which was calculated in the production budget, and then divide the production unit with 10, because each machine produced 10 loaves per tray. After getting the total production in tray, multiply it with hour per tray, and we will get the total direct labor hour. The total hour need multiply with the cost per hour, we will get total direct labor hour budget. Next is overhead budget. Input the total direct labor hour need which was calculated in direct labor budget. Input the variable overhead as known in information plus the variable overhead, and we will get the variable rate. Multiply the variable rate with total direct labor hour need, and we will get the total budgeted variable overhead. After the calculation of budgeted variable overhead, calculate the budgeted fixed overhead. Input the budgeted fixed overhead from the list in information plus the fixed overhead, and we will get the total budgeted fixed overhead plus the total budgeted variable overhead and budgeted fixed overhead, and we will get the total overhead budget. Next is selling and administrative expense budget. Input the planned sales from the sales budget, and input the variable expense as known in information. Multiply the planned sales and variable expense, and we will get the total variable expense. Input the fixed expense after that plus the variable expense and fixed expense, and we will get the total selling and administrative expense budget.
Next is ending finished good inventory budget. There's unit cost completion, consists of direct material, direct labor, and overhead. For direct material, each material cost per unit will be calculated by materials per unit multiply cost per unit. And for the direct labor, it will be hours per tray multiply cost per hour divided 10 because each tray consists of 10 bread. And for the overhead, there are variable overhead and fixed overhead. For variable overhead, the formula is total variable rate multiplied hours per tray, divided 10 because each tray consists of 10 bread. And for fixed overhead, the formula will be total budgeted fixed overhead divided production need dt from the production budget. Sum the unit cost computation and you will get total unit cost. The finished good nominal is from the desired ending inventory from the production budget in March. The finished good cost will be the total unit cost multiply finished good quantity, and you will get the ending finished good budget. And next is cost of goods sold budgeted. Direct material use is from the direct material purchase budget of flour, production need multiply cost per unit, plus direct material purchase budget of sugar, production need multiply cost per unit, plus direct material purchase budget of egg, production need multiply cost per unit. Direct labor use is from the direct labor budget. Overhead is from the total of overhead budget. Sum the direct material use, direct labor use, and overhead, and you will get budgeted manufacturing cost. At the beginning in finished good inventory, and you will get goods available for sale. Less ending finished good inventory. Ending finished good inventory get from ending finished good inventory budget, and you will get the budgeted cost of goods sold. Next is cash budget. Beginning cash balance is from the information. And cash receipt is from the total sales budget in January, February, and March. Beginning cash balance plus cash receipt, and you will get cash available. Next, less disbursement. Input the direct material, direct labor, overhead, and in overhead and selling administrative, you have to add back the depreciation. Sum the disbursement and you'll get the total cash disbursement. The cash available less total cash disbursement will get total cash need, and it will be ending cash balance. The ending cash balance will be carried down to February. Add the cash receipt. The cash receipt is from the total sales budget in February, and you will get cash available less disbursement, same as January. Cash available less cash disbursement, and you will get cash need. And the ending cash balance is carried down to March. Add the total sales budget and you will get cash available. Input the cash disbursement and you will get cash disbursement. Cash available label less cash disbursement, and you will get total cash need. The ending cash balance in March and the total ending cash balance has to be the same. Next is pro forma income. Sales. We get the sales nominal from the sales budget. We get the use the total sales budget. Cost of goods sold, we get it from cost of goods sold budget. Sales less cost of goods sold and we will get gross margin. And after we get gross margin, less it with selling and administrative expense. You'll get it from selling and administrative expense budget. And you'll get budgeted net income.
Next, these are the following transactions in January of 2019. And all the transactions need to be recorded in journal entries. 1st of January 2019 is purchase direct materials. They are flour, sugar, egg. The quantity times the price, and we got the total cost of direct materials. The journal will be direct materials of flour, sugar, egg to cash and bank. The 5th of January 2019, purchase office supplies. They are masker, glove, and hair cap. The quantity times the price will get the total cost, and the journal will be supplies expense to petty cash. Produce 2,000 loaf of bread. The unit per usage of direct materials times the cost per unit times the unit to be produced, we can get the total cost of direct materials. As the direct labor, we should multiply the hours needed per tray with the cost per hour, and also times the unit to be produced in tray, and we will get the total cost of direct labor. And the applied overhead is total fixed and variable overhead and total budgeted direct labor hour times actual quantity in tray and times budgeted hour per tray, and we will get the overhead control nominal. And the journal will be work in process to direct materials of flour, sugar, egg, direct labor, and overhead control. And also finished goods inventory to work in process. Next, selling bread to ABC market. The quantity is 2,000 and the price is 12,000 rupiah. The journal will be cash and bank to sales. And also cost of goods sold to finished goods inventory. On 15th January of 2019, produced 2,500 loaves of bread. Still the same as before, unit per usage time cost per unit times unit to be produced, and we will get the total cost of direct materials. And also the total cost of direct labor and the applied overhead. The journal will be work in process to direct materials of flour, sugar, egg, direct labor, and overhead control. And we also journal finished good inventory to work in process. And next, selling bread to ABC market. Quantity is 2,500. The price is 12,000. The journal will be cash and bank to sales, cost of goods sold to finished good inventory. On 25th of January 2019, produce 1,500 loaf of bread. And these are the total cost. This is total cost of direct materials, and also with the total cost of direct labor and the applied overhead. The journal will be work in process, direct materials to direct materials of flour, sugar, egg to direct labor and overhead control. And also finished good inventory to work in process. And next, selling bread to ABC market. The quantity is 1,000 and the selling price is 12,000. The journal will be cash and bank to sales, cost of goods sold to finished good inventory. On the 31st of January 2019, pay utilities expense in January 2019 for 3,375,000 paid from cash and bank. The journal will be utilities expense to cash and bank. And also with the rent, salaries, and direct labor hour. The journal will be rent expense to cash and bank, salaries expense to cash and bank, direct labor to cash and bank. And lastly, there are some transactions that will be need to adjusted, and we should make the adjustment journal entries. On 31st January 2019, depreciation of machine. The formula would be 100% divided by 8 years. We will get the 12.5% and times 12 million divided by 12 months, and we will get the depreciation machine expense for that month. The journal will be depreciation expense of machine to accumulated depreciation expense of machine. And this is the formula of depreciation of office equipment. And also with the fridge, the journal will be depreciation expense of office equipment to accumulated depreciation expense of office equipment. Depreciation expense of fridge to accumulated depreciation expense of fridge. And all the production expenses need to be adjusted to overhead. The production expenses including depreciation of machine, depreciation of fridge, rent expense, utilities expense, and supplies expense. The journal will be overhead control to depreciation expense of machine, of fridge, rent expense, utilities expense, and supplies expense. And we also need to adjust the variance of overhead to cost of goods sold. The actual is this nominal and the applied is this nominal, and it shows that the variance is this nominal and it's under applied. So we should make the journal entries cost of goods sold to overhead control. The inventory balance per 31st January 2019 or the end of month, it shows direct materials including flour, sugar, egg have this unit left and total cost, and also with the finished good inventory of 500. After all the journal entries, we will be able to make the report. There are statement of financial position and statement of profit or loss. The nominal from all the accounts are from the journal entries like cash and bank. It shows this nominal, and also with the other accounts, petty cash, direct materials of flour, sugar, egg, finished goods inventory, machine, office equipment, fridge, and accumulated depreciation, liabilities, equity, current earning of the year, retained earning. And we could see the total assets and the total liabilities and equity are balanced. And the statement of profit or loss, the sales show that 66 million and the cost of goods sold. Sales minus cost of goods sold, we will get the gross profit, and minus the selling and administrative expense, we could get net income. And this is the balance of net income. Next is the transaction in February. So this shows that the inventory balance carried down from January. These are the following transactions in February in 2019. All the transactions in February will be recorded in journal entries like January, but there are some of price changing, like Sweet Bakery managed to bargain with supplier to sell the flour cheaper, and the price of sugar has risen. And Sweet Bakery managed to bargain with the supplier to sell in lower cost of egg, and buying in lower quantity than the budget as in January of 2019 because Sweet Bakery didn't achieve the target sales. And also some price changing in the office supplies. So after all of these journal entries, we will be able to make the report like statement of financial position. Sorry, this will be 28. This is the balance of statement of financial position. It shows asset in this nominal, total liabilities and equity in this nominal. And also with the statement of profit or loss, it shows the sales in this nominal, cost of goods sold, selling and administrative expense, and it shows the net income in this nominal. Next, continue to March of 2019. And it also will be the same as February, but there are also some of the price changing, and also the direct labor hour. And next, all of these transactions will be recorded in journal entries. And after all of these journal entries, we will make the statement of financial position also. So this shows the balance of this statement of financial position. And also the profit or loss. And in March, it shows net income in this nominal.
Is the managerial performance report quarterly production or cost of goods manufactured. For the static nominal, you will input all the static nominal from the static budget. And for the actual, it was based on all the transactions which we have made into journal entries in January to March. And flexible, the production unit will be the same as actual production unit. For the production cost, the formula will be static nominal divided by static quantity multiply actual quantity. For the efficiency variance, it will be actual nominal less flexible nominal, and you will get the variance. And for the following variance, it was static nominal less flexible nominal, and you will get the variance too. If the actual production cost is bigger than flexible production cost, it is unfavorable. If the production quantity of actual is bigger than the production quantity of flexible budget, it is favorable. If in the flexible, if the production cost is bigger than the static production cost, it is unfavorable. If the production quantity is bigger than the static production quantity, it is favorable. Next, we will go to cost of goods sold. This is the managerial performance report quarterly sales or cost of goods sold report. The static nominal will be the nominal from static budget. The actual nominal is based on actual transaction which we have made into journal entries in January, February, and March. And the flexible is based on actual quantity and static cost. The formula will be static nominal divided by static sales multiply actual sales. Efficiency variance is actual nominal less flexible nominal, and you will get the variance. Following variance is static nominal less flexible nominal, and you will get the variance too. The net income of the actual will be the same as the total of net income from January to March. If the actual cost bigger than the flexible budget cost, it is unfavorable. If the sales quantity bigger than the flexible budget sales quantity, it is favorable. If the flexible budget cost bigger than the static budget cost, it is unfavorable. If the flexible budget sales quantity bigger than the static budget sales quantity, it is favorable.